Hey everyone, it's Elizabeth Stracely here with All American Home Group, and I wanted to jump on again and answer another question that a lot of people have, which is, how does my credit score affect my mortgage interest rate? So when a lender is looking at someone to approve them for a mortgage, the biggest factor, or one of the biggest factors besides your income, is going to be your credit score. The credit score helps the lender to be able to decide how much of a risk it is to lend you money. So, with that being said, the higher your credit score is, the less of a risk it looks to the lender in order to lend money to you, which means that they are going to give you a better interest rate. So, for you as the consumer and the home buyer, the higher your credit score is, the less likely you're going to default on your loan. So the bank is willing to give you a lower interest rate. Now, if you maybe haven't been the best at paying bills in the past, your credit score is going to reflect that and it will be lower, which means that to the bank, you look like it's going to be a riskier investment for them to lend you money. So that means that your interest rate is going to be higher, which means that your monthly payment will also be higher. So, lesson is, the higher your credit score is, the lower your interest rate for your mortgage will be, and the lower the payment is, which also means that in the end, you're able to finance more because your interest rate is going to be less. And you have the same payment on a higher priced home than someone whose interest rate is higher, and due to the fact that their credit score isn't so good. So hopefully that helped clear that up a little bit. Big takeaway is just make sure you have the highest credit score possible, pay all your bills on time. So, all right, well, thank you a lot for listening, and I will be on later this week with another question answered.